If you are having a difficult time trading right now, I'm going to explain in some charts as to why that is. It's a very difficult environment that we are in. I've been preaching that time and time again, and the conditions, they have not gotten better yet. Actually, today they got worse. We're going to be going over some charts, some indicators, and over the indices as well. Very important episode today, so I want you to pay very close attention. Let's get into it. All right, welcome back. So the first thing I want to do is bring up a chart that we are familiar with seeing. Okay, so what has been going on in the market? The S&P 500 has been levitating higher. Same with the other indices like the Qs. However, if you look underneath the surface, which is extremely important to do, you will notice that the percent of stocks that are above the 50-day moving average have been deteriorating and diverging for quite some time now. This can resolve in a couple of ways. It can resolve to the upside. Mainly small cap stocks start to catch a bid and we start to see this head back up to the upside. And then the indices, as long as those mega caps still hold their positioning, you'll see the S&P 500 go higher with it. Okay, but as of now, for these last couple of months, what's been going on? Well, it's been deteriorating. So you've been seeing a lot of bear markets in individual industries and sectors. It's been very difficult to navigate. And when you're in a difficult to navigate environment, what is it that you need to do? Well, you need to focus very heavily on sizing your positions. I have my own strategy for doing that. Everyone has their own strategy for doing that. However, the majority of retail traders, Robinhooders, what you'll typically get is if they have down days, they'll lever up on a position to try to make it back quicker. Now, that sometimes works out fine. But in market conditions like this, it's very, very difficult to succeed in. So, markets ebb and flow. They have multiple seasons. You're going to have wins. You're going to have losses. But the losses, you're going to have to really mitigate. I'm going to go to the next chart, but I want to touch on one more thing. So lately, I've been taking stabs here and there at multiple trades. And multiple trades had just been not going in my favor. And many people would be like, well, that's horrible. That's horrible trading. Well, if you actually read various books about position sizing and trading, what does that entail? Well, heavily on risk management and position sizing. So for example, if you were to lose 10 out of 10 trades, okay, which there's going to be times where that's the case. It's rare, but it definitely does happen. So let's just say 10 out of 10 trades you lose. Okay, you lose X amount of dollars. Let's just say out of those 10 for 10 trades, you lose $1,000. This is just for rough examples. Now your units of measurement will be different for everybody, right? If you're investing 1 unit or 2 unit, or if you're even using a unit-based system, I don't know. However, there's going to be periods of time where you have 10 for 10 wins. All right? So when you do the calculation here, is your 10 for 10 losses going to be wiped away completely by the 10 for 10 wins? So for example, if you're 10 for 10 wins and you're focusing on a 1 to 3 risk to reward ratio, if you had 10 for 10 wins, you should be looking at $3,000 for the example, right? So understand how position sizing is very, very important in this environment. I'm going to make a separate video detailing more in depth how to accurately position size, or a method that I use to really navigate the market. Now we're looking at the NYMO right here. There's another reason as to why it's been very difficult. So first off, the S&P 500 continually presses higher and higher. We have a little hammer candle today. I'll go into those charts in a little bit, but RSI has been diverging of the NYMO cumulative line. This is the advanced decline issues. It hasn't put in a higher high as the S&P 500 did. And now it's declining to the lower Bollinger Band and to the 50-day moving average. So this has been dropping off. The S&P 500 is levitating higher. What does that mean? We have more decliners, stocks, than we have advancing stocks. Now, if you look at NYMO, we use this as a breadth indicator. I like to look at overextended areas, whether it's to the downside, being oversold or overbought. Right now, it's reaching down into the levels of oversold. So it's possible to get like another VIX Crush Friday where we see that bounce back up. But just also note that we've been drifting higher on very poor breadth. And that's happened here. That's happened here. It's happened multiple times. So something to pay attention to. If you look at the advanced decline volume cumulative line, look at this. This has been completely diverging. So just a big drop off, and we cracked through this previous low. So we're putting in lower highs and lower lows here, and at the lower range of the Bollinger Band. We'll see what happens with this and see if it gets resolved. But that is not a good look as the S&P 500 has drifted higher. Meanwhile, you look at communications sector. It's a big sector for the S&P 500. The cumulative line here, we're looking at the volume advanced decline percent. That's been drifting down. Meanwhile, the sector's been drifting higher and higher. All these divergences are coming in, they'll resolve one way or another. And this is just adding to the reasoning as to why it's been a very, very difficult market to navigate. You need to be careful. The sell signal was triggered the other day. We were talking about that. When the sell signal triggers, what do we do? Well, we typically lighten up our load on position sizing. We update stop losses. We take profits in this environment, and it's continuing to move higher right here. So risk is a definite factor at play right now. If you look at the utilities cumulative volume advance decline line, the percent line, this one has also been interesting from a risk perspective, right? The volume's been going up, higher highs, higher lows. Okay, that's trending up. Meanwhile, the price action has been going lower. So that's a positive divergence on a risk kind of off type asset class, right? Utilities is typically, and consumer staples is where people go to play defense. Talking about consumer staples, we've been talking about this, and I remember talking about this very similar type looking chart, right? The relative performance, but it was way back when oil was looking just like this, or not oil, sorry, energy sector. And what I'm called out here is, yeah, maybe it's not the time right now, but it's not far from it. I mean, there's a positive divergence in the RSI on this relative line. So when this goes lower, that means the SPY is outperforming consumer staples, but it has been getting a little frothy here to the downside, and it's presenting a positive divergence and a positive divergence on the rate of change using just the standard default 12. You can see here a low and a higher low right here. Now this has happened a few times that I've marked out where you get spikes. Now this is relative performance. So this doesn't mean all of a sudden consumer staples does great. It just means that it can outperform the S&P 500, which lets me know during these spikes to the upside, it's a more defensive period. That's it. That's all. That's what that means. Here is Michael Gayad's utility over SPYs, utility over the SPY. And he uses this part of one of his award-winning white papers. If you haven't read that, I'd go read that. I believe this one was called the beta rotation strategy. And this, if it crosses above 0, that means I'm almost certain that's all from the interview that we had. That's all of his risk signals are now flipped to risk off. That doesn't mean crash, but it does mean that the conditions for something to happen in this market are significantly greater than they are if this was obviously staying here below 0, and then he also looks at the lumber to gold ratio, etc. So that's something important to watch. Meanwhile, the equal weight S&P 500 hasn't even put in an all-time high yet. It hasn't broke out to all-time highs, but the SPY has. The S&P 500 is breaking out. So that's a divergence. If you look at the value line geometric index, XVG, clearly diverging as the market's pressing higher. You can look at transports. Transports are the same thing, putting in lower lows, lower highs. S&P 500 is moving higher. Same with the industrials, right? If you just look at Dow theory, these type of divergences, they have to resolve in one way or another. And that makes it a very difficult environment to navigate, and it puts more risk on our platter, I guess you can say. Also to note too, if I were to type in HGX right here, that's the housing index, and they typically move in fashion with the broader market for the most part, and you got to watch for divergences. This looks just like the HGX, the housing index, right? It's been putting in lower highs and lower lows. So pretend this is that. It's not, but it looks just like this, and the S&P 500 is obviously moving higher and higher. So we have all of these divergences. We have these stealth bear markets. This is going to do a couple of things. One, it's going to either scare you and say, no, never, get out, all cash. I can understand why. But second is if it resolves to the upside, it does present some significant opportunities in the sectors and industries that have been getting destroyed and obliterated. So you got to think that. You got to think about that. Just keep your eyes open. Let's go to the indices really quick. Indices, S&P 500, obviously it was a down day, a nice little hammer candle. Price percent oscillator looked like it might be about to start to cross over. Look at VIX Crush Friday may take place where it pushes up again higher. I wouldn't be surprised. The overall trend, it's still good. Just note that the, behind the scenes here, as we saw the fangs crack today, that's going to put some weight on the S&P 500. If you look at the 15-minute time frame, there's a possibility for a bull flag here. PMO crossed, bullish crossover. It's still below zero, so we'll see where the market opens up after the futures, obviously. Dow Jones Industrials looks one of the strongest. You can see here. I believe it wasn't an all-time closing high. I think that was the all-time closing high, and it hasn't reached an all-time high, but it did break out of a pretty significant area here, and it has been floating above it. So industrials look fairly good. It's just the transports. The transports have been getting obliterated. So is it the transports that are going to catch up and really help the Dow Jones Industrials and the DJA, the Dow Jones Composite, start to press higher here? I mean, utilities are putting in a little work right now. We'll see it. We'll see what takes place. And if you don't know what that means, so the DJA is Dow Jones Composite. It's made up of utilities, industrials, and transports. Okay. The DIA, sorry, this little thing's there we go. DIA 30-minute time frame, 15-minute time frame. This is the Dow Jones Industrial ETF. The 5-day moving average, it's still nicely sloping up, so it's still in bullish context. PMO, it's bullish crossover. It's right there at the zero line to slightly above. RSI looks good. So everything looks good here. We have some support, probably right in around the 347.50 range, a little band of support, and we have a couple gaps down beneath us too as well. So we'll monitor that. NASDAQ 100 obviously today took a decent size hit, but it's not far from its all-time highs, meaning the structure here is still very bullish. So, we can't just, short into, it's actually very hard to short these environments because a lot of the times if you short on a gap down, you typically get the dip buyers ripping it back up. So I would say on the daily time frame, look at the 20-period moving average. The 20-period moving average is right around 1456. Am I getting that right? I can't. Yeah, 1456. That's the 20-period moving average. It could come down there. That can act as a level of support. I've seen the 20-period moving average act as support. It hasn't tapped it since this day right here in early June. So it's a possibility, but we'll watch out for it. On the 15-minute time frame, it broke its band of support that I was monitoring and it closed below it. That's not the greatest sign. It could be forming a little bear flag right here, but there's more support down within this zone. You can see it's matched with price action, the volume profile. So we'd be looking coming into tomorrow at 353.50 to 355 if it takes out this previous low. If we recapture this, that can act back as an area of support or it can act as an area of resistance. It might come a little bit above it, maybe get rejected. So just be mindful that OPEX week, including, coming in a Friday, we get some wild swings and it's very hard to, determine if those swings are just part of that OPEX or if it's, a rotation or, it's just various different things that can happen. So it's best to, let some time go, especially after this week to really determine, okay, is the trend breaking here? Is it going to be putting in lower highs and lower lows? Or is this just a little quick hiccup and then we're off to the races once again? It's possible, right? Russell 2000 is where it gets very interesting. Right here at the lower trend line, I guarantee you everybody is watching this. Right? Everybody is watching this darn trend right here. So watch for a potential break. That would be not the greatest sign. But, if it cracks a little bit below it, it's not necessarily game over. So we'll monitor it. I will say that every time it's tapped this trend line, you get these spikes in volume. And sometimes these are like, or spikes up to the upside. It could be an exhaustion bar, depending on, the direction of it. And coming into this area of support with a big volume, nice hammer candle, that could represent a bouncing point. Just know that the context here, it's technically, a little bearish. It's just overextended to the downside. We're below the 50 and 100-day moving average and the 20-day moving average. So it has some work to do, but I don't know if you want to put too much weight on these moving averages at this particular point in time because they haven't meant anything during this consolidation phase, right? The price action has been going sideways. The moving averages matter more when they are in a specific trend that you can really quickly spot and they're spread out like, here, boom, nice big river to the upside. But now, they're crossing over. So it's something to be aware of and mindful of. But right now you get a big spike in volume. You get this doji indecision type candle. It was a hammer candle earlier, and it's at an area of support. It suggests like, okay, that can bounce, right? And it could set up for a good risk versus reward trade if it came down lower, or if you want to enter in there, that makes sense. Just have a stop loss, below it. And as far as a stop loss goes, you can do a couple of things with the stop loss. You can put it right below it, or you can give it some breathing room too as well. That's really up to your personal preference. I'll make a video on how to calculate how far below if you look at something like ATR, which is a volatility measurement. Let's go into the 15-minute time frame. 15-minute time frame for the IWM. Bearish context here on the shorter term. Why? 5-day moving average is sloping down. The price action's below it. We're getting this little spike up. You can see the PMO got pretty overextended to the downside. Bullish crossover right here, and the RSI is trying to move back up. So it suggests that we can move higher here. Just pay attention to this band of resistance. So 217 I would say 217.80. 217.85, this is 216. I would say if we can get back above 219, so notice here this little kind of just little swing high, and then it cracked through this low. That to me signals that if we can get back above this, that would be a good sign as we see a positive divergence in the RSI, and this is, I would call that a positive divergence in the PMO. So short term, that could be a nice little bounce, a little pop. But if we start taking out 215 or I'd say 215 low, then I just be very careful, because that could be just a dead cat bounce. We're moving lower. We pivot right here at the 215. We found some support there, but if it takes out that previous support, it could come into resistance, which we've been seeing, right? Bam, bounces right here like that. Up, we took out that low, headed lower. We bounced up. Okay, up, we took out this low right here, and we headed lower. Now we're bouncing back up, so it's putting in lower highs, lower lows. Let's see if we can start putting in a higher high and a higher low. That would suggest that the trend would change. Let's look at a couple sectors and industries. This is the FANG Plus Index, so we're looking at the big weights here. Just notice that it came into this supply zone. We talked about this previous videos ago, and now all of a sudden it's, selling off a little bit, but not by much. We're right there at the 20-period moving average. If we start getting below that and taking out this previous low, then I'd be a little bit more worried. But keep in mind the area that we'd want to watch for, okay? And I think it's very possible, especially looking at the price of Amazon. Amazon did this multi-month breakout, almost a year. I have to look. It was basing for quite some time, and it just broke out. We saw this huge pop that was all over the news, and now it's starting to peel itself back over, curl over. So it could be going in for a retest. So yeah, Amazon's a mega, right? And if that turns around and starts heading lower, that puts weight on the S&P 500. And you got to be mindful of that. But if it back tests successfully and acts as support, well, guess what? The market continue its move higher with the mega caps. So it's something to just be mindful of. Here, still very bullish context. The confluence of support here is right at these moving averages, the 100, the 200, the lower Bollinger Band. So if we get a quick move to the downside, I'm thinking that we'd see a bounce right in this range, which if that's the case here on the FANG Plus Index, I'd be paying very close attention to individual FANG stocks at that particular point. Here's the semiconductors. Semiconductors also makes up a huge portion of the NASDAQ composite, down 2.74%. That is a big move, and you can see a lot of volume, a lot of selling. Area of support is the lower Bollinger Band, the 100-day and the 50-day moving average. Confluence of support there, and that matches with previous price action support and resistance. So where is that? 246.39. We'll call it 244 to 247, a little zone in there, okay? So if it pulls into there, we could see some sort of a bounce. Just to be mindful that if we do get down there, we are also putting in a lower low from this point, and that could signal a potential start of a trend change. A lower low, and then we might bounce from that point, but keep in mind we'd have to crack through this high to make sure that that's not changing, because if we come down, we bounce, and we put in, and we start moving down again, well, that means it's a lower high and a lower low, which could signal the early stages of a trend change. You can see the PMO down here also, bearish crossover, and it's kind of sloping down. Lagging indicator, but still important to watch. If you look at the BKX financials, 15-minute time frame, PMO looks like it's about to do a bullish crossover. Pay attention to the financials. I'm slightly in a small position in the financials, but I've just updated my stop loss as recently because, well, one, it looked very strong today, but then it sold off and then kind of regained some strength. So I didn't like that price action, so I updated my stop losses. We have a gap below us that can act as support. 5-day moving average, there is no trend here, right? It's just up and down. It's moving sideways. It's not like, you know, the Qs, how we just see it, or the SPY, you know, from bottom left to top right, a nice trending up. So it's a little bit of confusion. Could be periods of distribution right here, or could drop lower, or it could just be taking a pause during this whole week, this OPEX week, and we can see this continuation to the longer term upside, which it has been in a longer term uptrend. Energy also has been getting completely destroyed, so I wanted to call this one out. I took a stab today at an individual energy stock, and it just rolled over on me at the point of buying it in that I saw the strength. Go figure, it happens, but that's why you focus on position size and risk. Where can energy start picking up? I actually still don't think energy's over with. I think this is the market, you know, maybe scaring out, watching some weak hands. I do think energy is going to pick back up. I know there's other people out there that think energy is kind of just, it's done for, it's over. And that's a possibility, but I don't mind taking stabs at it given its overall longer term context. So in the shorter term time frame, positive divergence in the RSI and the PMO, still below zero on the PMO, but then I'm watching this band. So if it gets above 51 tomorrow, maybe breaks out of there. If it got gaps above, be careful, look for a back test or a gap fill, but depends on how it gets up there. So if it moves up and cracks through this previous resistance, which is also previous support, that would be a good early sign that energy might start bottoming out and catching a bid. But keep in mind the 5-day moving average, it is declining at this particular point in time. So you're fighting a little bit of a upstream right there. All right, everybody, that's all I have for you on today's video. Like I said, very difficult environment to navigate. If you're not taking that seriously, chances are you're going to blow something up, meaning your account. So it's very difficult to navigate. It's a time to be very careful. It's not a time to really rush into positions. You need to be slow and methodic in your positioning and your position sizes. All right. I don't know how many times I have to say that over and over, but I think it's something worth noting over and over again, because a lot of the times, you know, we trick ourselves, right? We say, oh, well, maybe this time it's going to be better. So then you lever up a little bit and then it goes against you. And then you're like, oh, I got to make that back. Don't do that. All right. You got to survive in this environment. And the way to survive is sometimes by sitting out either in cash or just doing less amount of trading, and or if you are still wanting to actively trade, lower your sizes that you're trading. That's it. Because there will come a time when the market starts going bonkers again. And when the market starts going bonkers again, if you've wore yourself out during a hard, difficult phase, chances are you're going to miss out on all the fun and excitement when the market starts picking back up again. All right. And if the market starts falling down, but yet you're very, aware of the current environment, well, guess what? You're not going to lose a lot because you're aware of what's going on and you're being patient. So that's all I got to say. Have a